Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 6:40 a.m. Mountain Time on April 2nd, Liberation Day. Um, as an aside, today may be the last real powder day of the season here. It's supposed to warm up beginning on Sunday, and we've got more than a foot of fresh snow on the ground. Um, I may sneak out and take a few turns here before Liberation Day really begins at 4 p.m. Eastern time on in the Rose Garden. So we did release a note last night. It was a March employment preview, and we thought the reaction to a marginally stronger than expected ADP report was reasonably telling. In essence, the Treasury market shrugged it off and just continued to rally in the belly of the curve. There was no positive reaction from S&Ps. In fact, they went down a little bit. They're down 54. And we think that's because even if we do manage to squeak out something in line with expectations, which are for, reasonably okay report, an unchanged unemployment rate, an unchanged participation rate, and job growth around 140,000, expectations will just be that it's coming a month later and we won't get a monetary policy reaction to it until we have definitive evidence that the labor market has weakened decidedly. So one example of that was Jason Furman on Bloomberg this morning saying he wouldn't expect the Fed to react to a weaker labor market until and unless the unemployment rate exceeded 4.5%. Now, the way we structured the report this week or this month was we began with a review of what happened in February as a reminder. And just to work through that quickly, we had a huge increase in part-time employment, over 1 million jobs. We had a big decrease in full-time employment, 860 some thousand jobs, which added up to net job creation of 150 or so. Chairman Powell characterized that as solid. We just don't see it that way at all. The U6 unemployment rate rose from 7.5 to 8%. The household survey showed a big decline in employment of 588,000. The labor force shrank by 385,000, which pushed the U3 unemployment rate from 4.011 to 4.139. We think that probably goes to 4.25 this month. Our model would have it at 4.27. The number of unemployed has risen over 100,000 since December. The work week is at a level only last really sustained from 2008 through 2010. So that's quite low. The Ag Hours Index is negative 0.3% annualized through the first 2 months of the quarter. The job findings and loss rates, finding rate plunged and the loss rate spiked, although that loss rate starting point was reasonably low. Powell has characterized the labor market as low hiring and low firing, but still stable. We think it's eminently unstable. As we move through the rest of our note, we then reviewed yesterday's JOLTS report. All metrics were weak. We had a big drop in openings that pushed the vacancy to unemployment ratio, one of Governor Waller's favorite metrics, down below 1, meaning there's fewer job openings than there are unemployed individuals. The beverage curve we walked through, we think, is at the maximum point of negative convexity. That's the model that relates vacancies or openings to unemployment, meaning any further, and the same is true of the Phillips curve, any further weakening of demand would push the unemployment rate up really quickly through that 4.5%. Furman was talking about the Fed having to be late. We don't think they have to be late, but we will see if indeed they are. Hiring was flat, and that hiring rate is quite low. The quits rate is low. Layoffs were up fairly significantly. That absolute rate is fairly low, but those have begun to move up. So the net effect of all this is that churn or reallocation fell again. That points to weaker wage growth in the coming months and coming year, actually. And obviously, we think demand for labor is quite weak as well. So, to preview the March report, we looked at things like the the Fed manufacturing and non-manufacturing surveys. We've had a big hit to business confidence over the last 2 months. That's shown up in 6-month forward order expectations, hiring intentions, and capital spending plans. Whether that shows up in the report on Friday or not is unclear, but it surely should. The ISM manufacturing employment index yesterday plunged to 44.7 or so. So clearly businesses have no intention of increasing hiring. One of the charts we missed after Friday's income, spending, and PCED deflator report was wages and salaries, sort of a core measure of labor income, has plunged nearly 2% over the last couple of months. That chart's in the note. We walked through the wage tracker and how much pressure there is on job switchers versus stayers, another measure of churn, which is quite weak, as well as the wage differential and how much pressure there is on less skilled workers. So all this speaks to us that the labor market is in a very unstable, precarious spot, and any further weakening of demand would cause the unemployment rate to rise quite quickly. We do think that'll likely be up this month, so we'll take the under on the number of jobs created despite ADP's number this morning. We'll take the over on the unemployment rate. We'll take the under on average hourly earnings, which are expected to increase 0.3% again this month. We think that's unlikely. And on balance, we'd have to assume at this point that bad is bad for equities and credit spreads, but pretty good for the Treasury market. If we do get an inline report, that might be the worst case scenario. A very weak report, we would expect to initially get a negative reaction, wider credit spreads, lower stock prices, lower bond yields, but that might get the Fed that much closer to a policy change, open market operation, or open mouth operations, that is, and that much closer, because we do get one more report before the May FOMC meeting. We may even find ourselves in a position for them to restart the recalibration process as early as May, though June's probably more likely. So that's it for me. Please have a look at the note. Barry Knapp from Ironsides. Have a good week, everyone. Thank you. Happy Liberation Day.